Nvidia stock has soared 2,200% in just 5 years. But what is driving this surge? Is it overvalued and can it sustain these results through 2025? Going back to 2020, when COVID 19 hit the world, Nvidia stock was trading around $5 to $7 per share. However, it wasn't until October 2022 that the stock began rising and making serious gains. But why did it suddenly take off? Well, it was mainly because the world started recognizing the potential of AI, and with Nvidia being a leader in the field, it drew a lot of attention, causing the stock to climb. On top of that, Nvidia consistently exceeded expectations quarter after quarter, further driving its rise. But can it continue? Well, many analysts believe that Nvidia stock will continue to rise, with strong buy ratings across the board. But let's dive deeper and figure out for ourselves why the company has the potential to grow in the future. First of all, Nvidia recently launched its highly anticipated 5070, 5080, and 5090 graphics cards, and the results are impressive. The 5070 performs just like the previous 4090 but costs only a third of the price, while the 5090 offers twice the power of the 4090 at almost the same costs. These breakthroughs are nothing short of remarkable. So why did Nvidia stock drop by 5%? A big reason is that during their CES presentation, Nvidia didn't dive as deeply into updates on their next generation AI processors, known as Blackwell, as investors had hoped. Despite mentioning that Blackwell is in full production, the lack of specific details left many disappointed. Their reaction highlights just how sky high the expectations for Nvidia has become. Another key factor driving Nvidia's future growth is its strong competitive edge. The company has established itself as a leader in the AI space, consistently outperforming its rivals. This dominance gives Nvidia a significant advantage in a rapidly growing and highly profitable sector, which I'll discuss more about later. However, as the industry becomes more attractive, competition is increasing, and maintaining that leadership comes with higher costs and risks. Despite these challenges, Nvidia is holding its ground by continuing to innovate and release cutting edge products like the Blackwell architecture and the GeForce RTX 50 series. Nvidia has also introduced Project Digits, a personal AI supercomputer powered by the GP10 Grace Blackwell superchip. This system is incredibly powerful. It can process massive amounts of data very quickly, equivalent to what a regular computer might take years to do in just a second. This level of power is called 1 petaflop. It's also capable of running advanced AI models that can handle up to 200 billion parameters, which are basically the setting or instructions AI uses to learn and make decisions. Starting at just $3,000 and set to launch in May 2025, Project Digits is designed to make super powerful AI tools affordable for researchers, data scientists, and even students. What makes this even more impressive is that competitors typically sell similar systems for much higher prices, putting Nvidia well ahead in the AI market. It's also important to consider the risks Nvidia faces, as there are quite a few of them to keep in mind. First, competition in the industry is intense. Nvidia is up against major players like Intel, AMD, and Apple. While the company has managed to stay ahead so far, keeping its lead in such a fast evolving market will always be a challenge. Another major concern lies in geopolitics. Nvidia depends heavily on TSMC in Taiwan for its production, and any political tensions involving Taiwan could disrupt their supply chain and impact their ability to meet demand. Additionally, a large portion of Nvidia's revenue comes from China, and tighter export restrictions on advanced chips could harm their business. For example, the US government has already limited sales of some of Nvidia's most advanced GPUs, like the A100 and H100, to Chinese companies. Lastly, while Nvidia is making moves into new markets such as automotive technology and AI supercomputers like Project Digits, these areas are still in the early stages. If Nvidia struggles to establish itself as a leader in these fields, it could slow down their long term growth. All in all, there are definitely a few risks associated with Nvidia, and it's crucial to keep them in mind. We've explored why Nvidia has potential for future growth and the challenges it might face. But now the big question is, how much growth does Nvidia need to deliver to provide returns that outperform the market? And more importantly, is the stock overvalued or undervalued? To answer this, let's dive into two key valuation metrics. First is the price to earnings ratio and the price to free cash flow ratio. Nvidia's price earnings ratio currently stands at 55.3, while its price to free cash flow ratio is about 60. These are quite high numbers. For context, to justify these valuations, Nvidia will need to grow its earnings per share by an incredible 742% over the next 10 years, which comes to an annual growth rate of 27%. At the same time, its free cash flow per share will need to grow by 165% over the same period, requiring a modest 10.05% annual growth rate. It might surprise you to know that these growth numbers would only result in a return equal to the market's average 10% return. So they have to grow earnings per share by 742% and free cash flow per share by 165% just to get the market's average annual return. Now, don't get me wrong, this level of growth could be achievable for Nvidia, but if you're looking for a higher return, say 13% per year, the requirements get even more extreme. Nvidia would need a 1000% gain in earnings per share and a 250% increase in free cash flow per share over the next decade. These numbers make Nvidia stock appear pretty expensive when viewed through price earnings and price to free cash flow ratios. Next, let's take a look at the discounted cash flow model. For this, we'll assume a 20% growth rate, which is quite high for a company as big as Nvidia. We'll also apply a 25% margin of safety because there are some risks involved with Nvidia. After running the calculations, we get an intrinsic value of $73 per share, and with the margin of safety, that drops to $55 per share. Now, when we compare that to Nvidia's current share price of $135 per share, it's clear that the stock looks very expensive. To make Nvidia appear undervalued, we need to assume a 35% growth rate just to match the current price. This would imply Nvidia could generate 862 billion in free cash flow by 2032. To put that in perspective, this is the same amount of free cash flow that all the major tech companies, what we call the Magnificent Seven, generated combined today. In fact, if you add up the free cash flow of these companies, it only adds up to 346 billion. So to match that 862 billion, you need to add another Microsoft free cash flow, then double it. This shows how difficult it would be for Nvidia to keep that kind of growth at its current size. Now, let's step back and consider Nvidia's competitors, AMD and Intel. How do they stack up against Nvidia? Well, Nvidia is leading the pack with some impressive figures. For instance, Nvidia has a gross margin of 75%, a profit margin of 55%, and a free cash flow margin of 50%, which are outstanding numbers. By comparison, AMD has a gross margin of 52%, a profit margin of 7%, and a free cash flow margin of 6.4%. Intel, on the other hand, has a gross margin of 40%, a profit margin of negative 30%, largely due to the heavy investments, and a negative free cash flow margin of 27%. As for return on investment capital, Nvidia again takes the lead with an impressive 63%. AMD follows with a solid 30%, while Intel lags behind with only 9%. These figures really highlight Nvidia's dominant position in the market, showing that they are not only performing better but also have a much stronger moat compared to their competitors. To sum it up, is Nvidia really worth the buy rating that most analysts are giving it? Well, not at its current price, but it really depends on whether you believe the company will live up to its high growth expectations. If you do, then it might be the right time for you to jump in. Personally, I'm not buying Nvidia right now. I'm skeptical about the business being able to meet these extreme goals. I'd rather wait until the stock drops to a more reasonable range around the $50 to $80 per share, as it's still a solid business with a strong moat and impressive profitability. However, with all the hype surrounding Nvidia, it's unlikely we see those prices anytime soon. So what does 2025 hold? That remains uncertain. Even if a stock is overvalued, it can continue to rise. But I wouldn't expect the same explosive returns Nvidia has had over the past 5 years, given its current high valuation. Thank you so much for watching. Now, if you want to get better at investing and achieve great returns, watch this video where I explain what really separates you from super investors.